Hey everyone, it's Imran back again with another Macro Options Daily. All right, US stocks finishing the week pretty flat last week. Tech slightly outperforming, banks still heavy though. Obviously, those regional banks going to continue to see pressure. I don't think that story is going to go away for quite some time. China also having a rough week, down about 3%, and they had a big miss on inflation in China. And that China reopening narrative really seems to be quite dead at the moment. So that's they're struggling with that a little bit. In commodities, metals taking a nosedive. The likes of silver down 6.5%, copper down 4%. Metal, the GDX gold miners were down pretty heavy as well. But gold did manage to only be down small, about 35 basis points on the week, which is nothing really. And oil also down, but nothing too dramatic, about 1.5%, which is not even a half sigma move on the week, basically, for oil. Nat gas, on the other hand, strong rally, 7.5% rally, which is actually only a one standard deviation move on a weekly basis, but still, in absolute terms, 7.5% rally isn't bad. And nat gas starting to feel like it might be putting in a bit of a base down here, but we'll see if it turns into anything. And then uranium, not doing a lot. Up 1% on the week, but at least managed to finish in the green. Had a stellar week the week before. So, showing some signs of resilience there. Looking at vols, we did see vols drifting back down. S&P obviously stuck around that 4150 area, can't really break away. So we've got vols back down on the 13 handle. But European vols, you can see, came down pretty hard on Friday as well. Best part of a vol point. So generally, just seeing all equities going down. And even China, down 3% on the week, didn't see vol pop. It actually saw vol 20 basis points lower on the week. So the VIX down to about 17 again, diverging from the VVIX, which is the vol of the VIX, as we have seen VIX call buyers come in and be more active. Looking at commodity vols, we saw precious metal vols down, copper vol catching a bid, about a vol and a half there, as spot broke down 4%. And that had been trading quite low in terms of where copper vol normally trades. And then you saw nat gas vol also lower as well. Carry wise, we're seeing a lot of, no positive really. All the positive carry that we had seen in Europe has gone away now as well. US has been a negative carry for a while, but just in general, not a lot of theta to harvest there. And same story in commodities where, you've got copper trading with neutral carry, but everything else in negative. In terms of skew, we did see skew pull back a bit, continues to kind of drift back down from recent highs. But the debt ceiling is still out there. Banking sector concerns are still out there. So those skews aren't really going to go back to the lows until some of these clouds start to disappear. But the debt ceiling probably being the main one to concern yourself with. And then looking at commodity skew, we did see a put bid coming back in the likes of copper and some of the metals. We also see quite a high skew in oil at 6 vols there, which is in the 90th percentile. Obviously, one of our trade ideas a week or two ago was to do some bullish risk reversals in oil if you were looking for a bounce. That seemed to work okay, but that skew is still elevated. So if we do get any more dips in spot, that might be a nice way to play it still. Okay, what else are we looking at? Range trading for now. So we've talked about, the last few months have been pretty frustrating for investors generally. There's a lot of these cross-asset markets kind of haven't gone anywhere. You've had the US 10-year trading in a range, the S&P, the DXY, everything's kind of stuck in quite tight ranges, and cross-asset vol has been trending lower as a result. And this has happened despite the noise around the US regional banking system and the debt ceiling standoff. So we do maintain the view that theta management is going to be important, trying to earn some carry where you can in safe ways, such as iron condors, things like that we think make sense still. Although from a more medium-term perspective, maybe looking out September, October time, we do think entering downside hedges, put spread type structures in general look quite attractive. And kind of because the timeline's very hard to call on these things, if the sell-off is going to come, you kind of want to buy yourself some time. Now, an interesting counter narrative against the doom and gloom that we've been seeing is the AI revolution that's happening before our eyes. And if we were to look at this similar to, say, the dot-com revolution back in 99, 2000, and the impact that it had on the NASDAQ, then we could see how if we use the 1999 analog, then the NASDAQ may just be getting started. Okay, so you can see here the green line is the 1999 analog, and the blue line is kind of what the NASDAQ is doing now. And you just see that, from say late June, early July to the end of the year, this thing back in 99 almost doubled. Okay, now I'm not saying that's going to happen, but let's have a look at what did happen and just kind of use it as a bit of a frame of reference of what really no one would expect to happen. But things can get very, very crazy. So if you think valuations are lofty now, there have been times where valuations have gone just crazy. Okay, so just something to be aware of. Now, I don't necessarily think this is going to happen, but if it did happen, I would think that NASDAQ upside is a bit cheap, looking at where it is in the teens. And then, maybe once the debt ceiling is resolved, if this type of crazy sort of move driven by the AI stocks was to happen, then it would only happen after the debt ceiling kind of uncertainty has gone away, right? So maybe using the passing of the debt ceiling issues as a signal to at least own some upside volatility in the tech stocks may be the way to look at this, right? So you don't have to call that this is the outcome that's going to happen, but owning some of those upside tails in tech means at least you're positively exposed in case it was to happen and go get out of control like it did back in 99. Okay, so those are the sort of things to think about maybe. But I think it's a bit early now, given that the debt ceiling's still hanging over us. Okay, so we've also been looking at German stocks, and we're wondering if the German stocks need to price out the China reopening. So anyone who bought into the China reopening optimism earlier this year has been pretty disappointed. The latest inflation data obviously missed massively. Fiscal stimulus has not been forthcoming from leadership. European stocks did rally early in the year as well on the back of this optimism. But as Chinese markets have faded, German markets haven't done a lot, right? So you've seen the big fade back down in FXI, whilst EWG, which is the Germany ETF, has kind of stayed up there. Okay. And we have seen recent German economic data missing. You can see that here with German retail sales, industrial production, and factory orders coming in very, very light relatively to what they kind of typically do. And obviously the ECB's got a hawkish stance, which means German stocks could be vulnerable. Now, timing's always difficult to call here, but the euro's starting to show signs of rolling over. And by September, October, we would expect some repricing to maybe take place in some of these European names. Now, looking at the DAX dashboard, we can see that buy puts is kind of screening as the trade to do just on the German DAX itself, with vols kind of at the low end of the range, and markets obviously up near the highs. Now, carry's pretty neutral, so that's saying buying options okay. But remember, this is DAX only. If we look at the DAX term structure, we see that the 1 month vol is very low, but then there's quite a steep contango here. So if you look at kind of September, October time, the vol is a bit more elevated, right, at around 17 odd. So maybe if we're going medium term, it's not so obvious to just buy outright options. And if we look at the skew at 6 vols, and if we look at the 3 month skew that's, even a bit higher, maybe you want to go for a spread with less Vega on it. And if you were to use a put spread, you would take advantage of that higher skew level, right? So that's kind of what we would suggest. All right, that is the one for today. Thanks again for listening. I'll catch you all tomorrow. Cheers.